Hi, my name's Donald Boyd. I'm the head of growth here at Azets. Today we've got a session on preparing your business for sale. We found that many of our clients are looking at what their succession plans are, particularly in the back of the recent budget. And also there's been quite a widespread phenomenon of a lot of the businesses that we see having unsolicited approaches, even when they're not maybe ready for sale. So I'm welcomed today by Simon Roberts from our Bradford office. He's one of our tax specialists, and Andrew Rowe, an accounts and business advisory partner here in the region as well. So turning to yourself, Andrew, so that call comes in from the client. How much am I worth? What are you then saying to them?
Well, I suppose we usually look at what we've discussed with them previously to that. Hopefully we've put some sort of planning in place, or we've thought that they may be ripe for sale or maybe or succession. But often it happens out of the blue. And then we've got to really sort of help from an accounts point of view, I suppose, is making sure that their sort of systems and things like that are robust for a due diligence process. But also I think to get the rest of the expert team involved sooner rather than later. So you've got your tax side, your corporate finance side, just to sort of make sure that the client is realistic, I suppose, because if they get especially an unsolicited approach, they just see the top figure and not always the realistic figure.
Absolutely. And Simon, you have to pick up the pieces, I suppose, sometimes when you've got that unsolicited approach, and the business isn't quite ready for sale. So probably counter to what we're talking about here. What do you tend to find then from a tax point of view?
It really highlights the point that planning ahead is massively important. There are things in the tax world that we can affect. There are things that we can help with. There are also things that need to be in place for a certain amount of time if we want to get the optimal outcome. So the surprise call from the client is sometimes quite difficult to get the best tax outcome. So the best thing we can always advocate is that early engagement. Other than that, it's managing the process as best we can, trying to get structures right properly, trying to ensure that deals are done in a way that's tax efficient. But sometimes very difficult if it's an unsolicited approach. Clients sometimes aren't ready, and due diligence is something that's very real for finance and it's very real for tax as well. When someone buys your company, they're going to take over your tax history as well as your financial footprint.
Yeah. So, I mean, obviously that's not the ideal scenario. So if I just rewind back to what would be your ideal scenario. So I've got a business, I'm doing quite well, I'm thinking of maybe an exit in 3 to 5 years. What should you be advising me?
I think the best thing we can do is review what you'd like your outcome to be. And I think Andrew would agree that sometimes the best thing a client can ever tell you is what they'd like to achieve. We can get hung up on technical details sometimes, but if someone gives you an idea of what they would like their outcome to be, then we can plan around that. It's about making sure that we're clear on what we're going to sell. It's about making sure that we definitely get the tax reliefs that we want to access when we do sell. It's about making sure that if there's any gremlins we need to deal with, they're dealt with long in advance so that a buyer has confidence in us throughout. It's lots of little bits just being tipped onto that right track, but working with a really trusted advisor and someone who's been through the process lots of times, someone who really understands what it takes to get from I'd like to do this to having the money in your bank account.
Yeah, absolutely. Andrew, I mean, you'll concur with that. One of my colleagues mentioned it's a bit akin to selling your house. You want to make sure the weeds are out the driveway, the grass has been mown, and you've given that dusty side cabinet a good polish.
I suppose it's really sort of cleansing the record keeping and the processes and stuff like that. So, and trying to anticipate really the sort of questions are going to be asked from the buyer side. So looking at contracts, looking at leases, things like that. Looking at any sort of oddities that might be in the business. So you may have had a family member on salary or a vehicle or something like that, and just sort of normalising the business so it's easier then when someone asks the question.
Yeah, absolutely. And you touched on the due diligence side of things, because that obviously in a transaction, a relatively innocuous tax issue can suddenly explode. So what do you find there, Simon?
It's sometimes a question of cost. There are certain issues where they can be resolved, but they will cost money to be resolved. And Had action been taken earlier, we might have had better penalty outcomes, we might have paid less interest. Ultimately, the amount of money that's left in the business is going to affect the sale proceeds. So sometimes it's a matter of cost. But one really important thing to remember is sometimes it's an issue of confidence. When the buyer comes and looks at your business, we give them accounts, we give them financial information, and they use that information to determine what they believe the business is worth, how much income it's going to produce in future, can we afford to grow this business, etc. If they don't trust that information, it's really problematic for you and it starts to erode the value. Or in really, really extreme circumstances, buyers can walk away because if they don't trust what they're being told, if they don't trust that you've looked after your tax affairs properly, they think, this might be problematic for us, and they might move on and look for a better fit. So it's not just about the pounds, shillings and pence sometimes, it's about the confidence of the buyer, it's about having a really good process with people trusting what you tell them.
Yeah, and just on the back of that, you mentioned to me that we can advise on warranties and indemnities and things like that. So tell me how that works in that part of a transaction.
So when we've done the fundamental heads of terms in a deal, we've worked out what the core terms of the deal is going to be, who's going to get what money and when, etc. There is an assumption that there'll be a process, and normally when you sell a company, which is what most of our clients do, we'd be expected to go through a process of due diligence where they ask us lots of questions, but there's an alternative legal process where they ask us to warrant a lot of things. And effectively what we're telling them is, these things are true about my business. I have definitely kept my accounts up to date. I've paid everything on time. There's nothing I haven't told you about. And sometimes we offer indemnities. We'd say, well, that might be in a bit of a grey area, but if it goes wrong and it's from our watch, we'll pay that. Sometimes we advise people not to enter into indemnities because it might be inappropriate, or it might be that the buyer is pushing us to do something that's unreasonable. Again, it comes down to the skill of the advisor to guide you through that process. But you've got to have that expectation that when you sell the company, you're going to be asked to give assurances that what you give people is in a good order. There's no nasty surprises lurking. You haven't done anything terrible that's going to come back to bite them.
So moving a bit more upstream, Andrew, so back to the client thinking of doing something with their business, what's the typical options that you go through with a client and what they can do?
I think certainly our role is to provide them with all the different options and scenarios and do a bit of a what-if analysis with them, really. We're going to want them to sell their shares, probably. Sometimes the buyer wants to buy the assets, and the shares is usually more tax efficient. I'll step on your sort of sign. But so we just really want the client to understand what happens at different stages, if you know what I mean. And also I think they've got to understand we've done it more often than they have. A bit like selling your house, you probably only sell it once or twice in your lifetime. So they won't probably have done this many times unless they're a real serial entrepreneur. So this is a real big decision they're going to have to make. So they're going to have to lean on the likes of ourselves and a good corporate lawyer and all the different advice we can do. So I think it's really just sort of giving them a bit of comfort that we've been there and done it.
Yeah.
And we know what happens at this stage, and just, letting them lean on us, really.
Certainly I've found that sometimes the question that's getting posed is not actually the question that needs to be answered.
Sometimes it's digging around the edges of it.
I maybe shouldn't be selling the business. Maybe it is a family succession matter. Or an MBO. I mean, Simon mentioned employee ownership trust to me earlier, as a particular option there. So.
And again, this is why it's important to focus on outcome, to provide something that the client really wants. Do they want to sell their business because they'd like to reinvest the money in something else? In which case, one structure might benefit, be good, but another's not. Do they want to take that money and fund their retirement? Should we be thinking about pension options in that case? Do they want to take that money and purchase a capital asset like a house or a holiday home? We need to know what they need from the transaction in order to match them with the best transaction to actually undertake. An EOT, just for explanation, an EOT is a sale of a business by a shareholder to a trust set up for the benefit of the employees. This is massively attractive in the tax world because the gain is taxed at 0%, absolutely fantastic outcome for the shareholder. But more than that, some business owners truly want to reward the people that have helped them get to where they are, the team that they've built up over the years, the staff that they've worked with side by side, they've been in the trenches with them. They want that outcome for the staff as well. So if we pick that up from these conversations in advance, that people really would like to do something with the staff, they would like the staff to benefit, it can be a great incentive for the seller to execute a transaction like this. Obviously no tax on the exit, which is a fantastic outcome, but also it can be really beneficial for the staff members, and it can be great for the business as well, because it acts like a staff retention tool. The staff will be much more inclined to stay in a business where they know that the profits of the business will eventually be theirs because the company's owned by them. It's a truly fantastic outcome for a lot of people.
It's a really strong option amongst the other options there for businesses, but I think it's fundamentally the planning and know where that capital's going to go.
Yeah, and it's not for everybody.
Absolutely.
Not every transaction would be a suitable one for an EOT. Just because there is this beneficial tax outcome doesn't mean that it's definitely going to be the best transaction. And this is again where we'd like to involve our ABAS colleagues, because transactions like that probably mean there's going to be lots of deferred consideration. We need to be happy that the business over the longer term is going to produce the cash to pay us off, because there's probably not going to be an outside buyer who comes with some upfront money, and there might not be a bank either. So we have to have the confidence that the business is capable of generating those profits, that it's likely to have the margins, and it's likely to keep everyone interested in the meantime. So that's why it really needs to be a very good joined up affair.
So just staying on the capital taxes, substantial shareholding relief certainly comes into play, which sounds a very grand title and all that, but just in layman's terms, could you explain what that is?
Yeah, effectively, it's a tool that we've got in our arsenal. Substantial shareholding exemption allows companies to sell either whole companies or shares in companies, and where they meet certain conditions, which are not too onerous, but where they meet those certain conditions, they can have a tax-free disposal of a subsidiary. Now, in most transactions, the outcome that people desire is that they would like to have some money personally, and they would like to either fund a retirement or fund capital purchases, like we said before. But some people, certainly serial entrepreneurs, want the money to reinvest. In those circumstances, it might be massively beneficial in tax terms for a holding company to sell its trading subsidiary, pay no tax, and have more money available for reinvestment to build a bigger business. So we like to tap into that. Again, if that's the outcome that's required, if that's what we're aiming for, we will plan around that in advance to say, let's get the structure right in advance. Let's make sure we're going to qualify for this tax relief in advance. Let's make it clear that when we prepare marketing material to sell this business, that's what's available for purchase, not the holding company. So again, good preparation can lead to us tapping into even bits of the market that lots of other accountants wouldn't even think about. Another way that that's used as well at the minute is some families might use that to sell a trading business and then create a family investment company in the holding company that's left behind.
That's the good old family office that you hear about.
A family office, effectively a family office, but the family office is started by the disposal of the trading company, and we get that extra kickstart by not having to pay tax on the disposal of the asset in the first place. So a really nice advantage where if we use the system correctly, we've got a much better investment return just because we haven't paid tax.
Yeah. Andrew, just turning to you, I mean, you advise a lot of clients. Is there a change in mood music following on from the budget and the changes in capital taxes? Has there been a rush for the 5th of April or not?
I think there was a little rush pre the autumn budget to get stuff done because they knew something was coming. And then there was a feeling there would be a rush to the 5th of April 25, but then it was sort of felt that you really got until the 5th of April 26 to really make the big decisions, So I think the lawyers and our tax team were pretty busy up to April. And then obviously the other side of the sort of corporate deal then is the inheritance tax side and stuff like that. Probably much more falls into our private client tax team, but they have to work with our corporate advisors at the same time, because if we do have a big capital sale and it's going to go to the family eventually, we've got to plan the best way around that as well.
Yeah, no, that's fine. Simon, just one last point. So if you're giving a business advice they're thinking about their future and what they're going to do with their business, what one fundamental bit of advice would you give them?
Yeah, I would say be clear on what you want. Be clear on what you are going to sell. Be clear on what is required to get the tax relief you want to tap into, and then find the right people to help you do it.
Yeah, thank you. Andrew, same question for you, but maybe not more with the commercial rather than the tax lens on this.
I think the real key, I think, at that point is confidentiality. So both externally and internally. Mm-hmm. So externally, often you'll be asked to sign some sort of non-disclosure or exclusivity agreement, which sort of you've got to keep to make sure everything goes properly. But I think internally as well, you've got to let the right people know at the right time. Mm-hmm. It's secret, but you're going to need the support of your key staff. And say the deal does fall down for whatever reason, you need to retain their support going forwards. So it's just timing that properly, really, and just thinking about the confidentiality side of it.
Yeah, no, thanks. And from my point of view, it's looking at your business from a strategic point of view, because we all live day to day operationally, even in our own business, but actually taking that step up and looking at what's my strategy here for myself, my family, and succession. That's certainly, my bit of advice. If I take Chair's prerogative there to throw in another one as well. So thanks, Simon and Andrew. That's been great bits of advice there. So if you are looking at selling your business, or even if you're not, you need to fundamentally look at what your strategy is for the succession of your business and where those shares are. So we at Azets, we love to speak to business about their future and what their strategy is, because we can provide you with some fantastic advice, both in terms of the tax structuring, but also on the commercial decisions that you need to make.